Welcome to this week's episode of Bonding Over Bonds. I'm Jim Jackson. It's my colleague Kevin Kazi, and this episode closes out our first month of Bonding Over Bonds. And I have to tell you, Kevin, we've been doing so much bonding, it's starting to feel a little awkward.
It's getting a little scary, Jim.
It certainly is. It certainly is. So I now to get back onto fixed income. Good week in the markets this week.
It really has been. Returns were driven by Treasury yields falling and credit spreads actually doing much better. It's amazing, Jim, how resilient credit spreads have remained, even with the equity volatility over the past couple of weeks.
Okay, credit spreads have operated within a very narrow range all year, really. And I think an interesting point is that Treasury yields since the end of the quarter have operated within a very narrow range. And actually, since the inflation scare from the CPI print a few weeks ago, they've trended down. It causes me to think, is this the market's increasing acceptance of the Fed's transitory argument?
So it's still too early to tell. I think we expect the debate to continue on through the summer as more data is released.
You know, Kevin, we're not only seeing good performance in fixed income, we're also seeing increased issuance in the market.
We are seeing a lot of new issue in the corporate bond market. This week we're expecting 25 billion. We actually, as of Thursday, we're over 38 billion. One thing to note here is this is the fifth consecutive week of over 100 billion, fifth consecutive month over 100 billion. We haven't seen that ever before.
Well, certainly the markets have been open all year. I think a big takeaway from the last couple of weeks, particularly when market commentary is very focused on inflation, is that it is very difficult to predict rates. Everyone was saying inflation is going higher, rates are going higher, yet rates have been fairly flat over the last couple of months, and in the last week they've gone down. So we think for fixed income investors, what they should do is maintain a diverse portfolio consistent with their risk tolerance and not try to predict interest rates. So Kevin, thanks for being here this week, and thank you, the viewer, for joining us as we bond over bonds.